Well, Rohit is also joining us on the show. And firstly, Rohit, what's your view on the market, especially when it comes to Nifty Bank Index? We are still seeing some weakness when it comes to private banks.
It's an interesting spot. Bank Nifty has actually led the correction so far, and it's actually ended up holding the 40-day average. So the level there is around 43,467. If it manages to hold that, we would see a slightly different pattern from what we see on the main indices and the mid caps and Bank Nifty. So what we're really trying to judge here, can Bank Nifty have the strength to keep the market momentum going, and for that it would have to manage to keep holding this level over the next few days and maybe even start a rally from here. Now we can't be sure that happens, but what we can get, maybe because something's got to support the Nifty's final move, I think. When we just do a cross examination of what has been going on, the broad market is where the strength has been, so almost 7-8 days of consecutive positive closes on the Nifty mid cap and small cap indices, showing that individual stocks just continue to race up every day. And in doing so, the RSI indicators actually hit around 87 on the Nifty mid cap index, which is a very, very overbought reading. And what usually happens when you get to a place like this is at some point of time, you end up getting a knee-jerk reaction. We can't say that happens today or tomorrow, but you know that you're close. And so therefore, making fresh entries in stocks, especially traders, have a risky place to be in right now if they're trying to take that bet. But having said that, because the Nifty did not fall, in below its 20-day average in the last 2 days sell-off. In fact, it took support very close to that. The level was at around 18,600 and we made a low of around 18,660. We can make one more attempt, to 18,900, or if we are really lucky, even touch 19,000. But like I said, the broad indices are saying that at some point this market needs to pull back. And so if I really need to take a more serious positional trade where I can buy something and hold on for a month or something, I would really want to wait for a consolidation, pullback, retracement of this entire rally that we've seen from the markets before I do that. So I think there will be better opportunity in terms of entry points for both investors and traders. But very short term, we need to even wait and watch to see when that happens, because clearly the market is still not relenting. So, and Bank Nifty is where that support can come in. So what I was talking about is that, if you do head towards 19,000, what will support the Nifty in the very, very short term? Possibly Bank Nifty, because it's already taken support at the 40-day average yesterday.
Right, Rohit. This is Vinny joining in the conversation as well, and a good afternoon to you as well over there. I want to understand, when I'm looking at it from a year-to-date performance, Realty, FMCG, and Auto, those were the ones that were doing well in terms of the performance, have been the best performance sector-wise. Today, when you're looking at it just today, we're seeing all these three are trading in the red. Do you think that the rally in any of the sectors is done, or we have bigger push and bigger upside for this now?
So Realty, FMCG, and the third one you mentioned, autos. So there's always two things. One is short term and one is long term. Now, my sense is that from the lows of 2020, India started a bull market. 2021, 22, most of 22 went into a consolidation phase. It didn't end up being a severe bear market, though top to bottom we've seen an 18% cut into the lows of March. Now, the reason to mention this is that when we say that we are in a bull market, and if we probably resumed that phase now from the lows of March, then what we are really seeing is a very, very broad-based advance in the market where every sector ends up participating. So it becomes hard to say. You can't really say FMCG goes down and auto goes up. But what I do anticipate from a long-term perspective is that sectors like FMCG, which were the darlings of the last decade, will at least underperform a very similar cycle like we saw from the 90s to 2000s, where FMCG, which was a outperforming sector for a decade, ended up underperforming for the next decade. So I think that's a pattern I expect. Doesn't mean they go down, simply means that other sectors are going to do much better than the FMCG sector itself. Now then moving to Realty and Auto. Realty is among the emerging sectors, right? It was the ones which is beaten down for most of the 2010s. It is now starting to move up with the market. So likely does well. We're probably not sure whether it will do as well as it did in the previous realty cycle. It'll do well. I'm not saying it won't, but the last cycle was extreme. You saw 50, 100 time kind of moves. I'm not sure that happens because a lot of these stocks are now discovered and therefore and mature, and therefore what you'll get is some kind of compounding, but not those kind of wild moves. So definitely the reality sector. See, now that moves us to the short term. Now we've seen a pretty strong rally, and if I have to make a fresh entry into any of these, whether it's autos or whether it's reality, I would really like to wait for a pullback, which is what I mentioned earlier. That if we look at these stocks, there are a lot of divergences. They may complete what we technically call is a 5-wave advance. 5 waves basically complete a trend, and then you get an ABC kind of a 3-wave retracement pullback. And that's what we'll end up looking for in most of these stocks and sectors before we really make entries. But longer term, I think they look good.
Right. And Rohit, also, what to understand, you did touch upon the broader markets, mid-cap, small-cap space. Would you find anything interesting in terms of stocks over there? Anything you would want to talk about or give us in terms of suggestions of stocks from the mid-cap and the small-cap space? What would be looking interesting?
So there are areas, I think, different areas to focus on. Let me just highlight at the upfront that any stock, if I end up mentioning in discussion, we are not investment advisors, so they're just opinions based on what we do because we invest for ourselves. We don't run an advisory business. We only share analysis, and we actually into a software platform now, which we are going to be launching. So when we look at these mid caps, I think specific segments, say for example, manufacturing, okay, there are a lot of small companies that are expanding in areas like boards, electrical boards, and so on. Different segments which you'd want to really look at. Now, for example, you had the darling of chemical stocks through the last several years, but I think it's shifting to different areas. So those are places to look at. Even if you think about, say, pharma or IT, say, for example, technology, I would really not want to be in the big technology names. I've not been a tech fan. But most of the gains have really come from the mid-cap IT stocks, new emerging stocks, which are trying different things than simply being labor arbitrage businesses. Possibly that is where the action ends up being. So then really focusing on individual names rather than a sector as a whole. So that is what will happen in places like pharma or IT. And then you look for different ideas. Like I said, the Make in India story related stocks, or then there are some related to the power ECG area. Those are things I think to look for in growth. One of the ways we technically identify that is I look for, say, over the last 1.5 years, if you have a period where the market's been consolidating, I'll run a query and I'll say, okay, which stocks are holding above the 50-day average for the last 2 years, and you'll see a very large list of stocks. There'll be a bunch of mid and large cap, and then within that we try to say, okay, out of these, which are the ones which have some quality fundamentally, and then that ends up making the basket on which we would want to invest into for a higher rate of return. So just to give you a highlight, even names like which are in defense, names like Hindustan Aeronautics or Indian Hotels, which are some of the large caps, even though we're talking of mid cap, actually ended up showing up in that list because they've really not broken down. No matter what happened to the market, we've seen stocks like HAL and Indian Hotels just hold on to their overall trend and continue to head higher. In fact, we've also seen that kind of a pattern among PSU stocks. Now, PSU stocks you would generally call large cap, but looking at the valuations they've had over the last 2 years, where dividend yields are were closer to 10% now, even if they are at 7-8% in some cases, you would say they're much better on valuations compared to many of the highly valued companies. And to people's surprise, they've also trended pretty strongly. And then you look at odd names, say for example, Coal India, which was from being the most loved stock when it got IPO'd, everybody wanted to recommend it. It did extremely badly over the first 5 years. And now since 2020, it has gradually been doing better. And on a 2-year basis, just doesn't fall below its 50-day average, So that kind of stock then gets our interest that, this is a place you want to be in because it is trending. So this is our approach. I've just given you some ideas that actually fall in that space, and so there are many others, and you have to keep verifying. Even in mid caps, then you have to go and verify. Okay, this is holding up, but is it genuinely holding up, or is it just there? So that then helps us get the right picks.
So, Rohit, when it comes to the insurance space, of late we have been seeing a lot of buzz coming in. A lot of insurance, all the insurance companies, be it HDFC Life, SBI Life, ICICI Pru, or Max Financial, they have run up more than 40% from the March lows. So, how does the valuation look like for the insurance space, and what view going forward?
So both are really mixed. Usually, when a stock gets listed for the first few years, we try to avoid it. Now, I think it's been quite a while since these stocks have been around, and we can say from the lows of say 2020 all the way up, these stocks really took a deep hit. Some of them have actually retraced 60 to 80% of the advances, and having done that, the risk reward really becomes more favorable because you've pulled back a lot. Now they will not fit in my earlier model, which I said, okay, stocks which are holding out and outperforming, which means they don't fall below the 50-week average or something like that over a 2-year period. They won't fit that model, but that doesn't mean that they can't do well, because even after a big retracement, they can resume their upward trends, which is sort of what we are seeing, I think, in the insurance space. So they started to participate again in this wave. We would probably try to think that this is, in our language, it is a third wave, because we had the first rally from the lows of 2020 to the top in 21, 22. And from there, they gave back a lot of those gains, I think, to the recent low that we have really seen. And we started to pick up from there again. So we'll try to think this is a third wave typically, which means you'll go past the highs that we saw in 22 for this basket, which is good in terms of giving some kind of a market linked return.
Okay, Rohit, thank you so much for joining in with us this afternoon, giving us a time, understanding on most of the sectors that we've covered, plus some stock specific names over there as well that you gave in. Yes, sir. Thank you so much for that, Rohit.